What's going on, guys? Welcome to this lesson hosted by me, RFX. We're going to be talking about what is range liquidity today. Now, range liquidity is the aspect of the market that we use to trade on every single time frame. For anybody that doesn't know, the markets are fractal. If you haven't already checked out the lesson on fractal price action, head over to the Telegram and check that out. But we're going to be talking about today exactly what is range liquidity and how do we use it inside of the market. So we're going to start off with some basic diagrams, then we're going to go down to the live chart and we're going to show you some examples of this and how it can play out and how we can use it to catch trades. So the number one thing we need to understand is what is it, okay? So straight away, we're going to talk about an upwards range move and a downwards range move. Now, they are pretty much the same thing, except one is going up, one is going down. Really, really easy to understand. All we need to think about is what are these moves showing us? Now, the first thing we need to understand is what defines a range. What defines ranged liquidity as a whole? The first thing that we need to obviously establish is, has a given move broken structure? So in this case, if we just add some fake structures here, just so we have something that price has broken, and the same for this one here, we can just add some little rubbish structures that price has broken. So we understand that price has broken a certain level. In this case, this level here and this level here. Yeah. So that gives us a new structural high and a structural low. So that structural low is going to be identified by the price that it took off from to break the structure. Okay. And then where it stopped and started to pull back on itself. Now, the same case goes here. You know what we're going to do? We're just going to scrap this one here. We're just going to work on the buy side. We don't need two. Two is too many. So we're going to go back over to here. We understand that it's broken structure, and now we have a low and a high presented to us. So what's the first thing that we want to be doing? The first thing that we want to be doing inside of the market, personally, this is what I like to do. Again, you don't have to copy me. You can do it however you like, but I like to range off the structural low and the structural high. We can then assess what is this move and how is this move presented to us. We understand if it's broken a high, it means there's an investment at the lower level. Why do we know there's an investment here? Because price has pushed higher, that means that there is a high level of liquidity coming into the market, driving price above levels that it was previously stopped at. So we understand price is being driven higher. When we get to the top, we're having two different things happen here. One of the things that we are having happen is the big guys that got in down here are starting to take some of their profits off the table, causing price to drop back down. Now, each range has a choice. So with any given range, the low is going to be the point of invalidation, and the high is going to be the area that we'd expect to be liquidated. Now, this is only relevant for an upwards range, okay? If it's downwards, it's going to be the opposite. Overall, with any given range, we'd expect price to do this. We'd expect it to play back down in a trending move, taking us back to the area that price was invested at from the low point. Now, one of the very key reasons we see this is because of the way the markets move the money, the way the money makers inside of the market control and manipulate what we see. Now, this is a fractal understanding of what price is doing, and we're going to go down to live price like I explained earlier, and we're going to go through some live examples to show you the real intricacies behind it. Now, when we have these areas, for example, a POI, or a push up, the last upshift before the down move, or the last down move before an upshift, like that, for example, this area is where the big guys are getting in. Now, this investment here that I spoke about earlier is not an investment that we can simply enter into the market. So if you think about how we trade as retail traders and how every single one of you that are in here watching this live, and anyone that may be watching this on YouTube from the recorded session, how you trade. Overall, you're going to be trading in a way that you can just click a button and you're entering the market, right? This kind of volume that pushes price above a serious level or a structural point, doesn't even have to be a major level, just any structural point. This is a huge sum of money and a huge amount of lots that are entering the market here. Now, when you have that kind of volume entering the market, it can't be introduced in one tiny little area. It's introduced in a staggered way. Now, one of the ways they do it is they'll have a push up, a pullback, a push up, and then price will take off. So they're entering in a given area, right? Because we're talking millions of lots here. Anyone that doesn't know, the markets work on a one-to-one basis. So if you have one person selling, you have to have one person buying. It has to match. This is why we had things like retail traps, inducements, and overall just a market that looks like it's going one way when it's going the other. If you haven't checked out the video on retail traps, head over to the Telegram and check that out. It will explain a lot to you in the way that I'm explaining this here. So what do we expect from any given range? We have a push up to an area, profit taking occurs. We then expect, if this range is going to hold and the structural levels are going to hold, we'd expect a reinvestment at the level the big money got in. Now notice how you're seeing the same thing here. Price pushing higher, pulling back. Price pushing higher, pulling back. What does that represent? Represents an upwards trend. Now the same example was given in the What is Smart Money Concepts video over on YouTube. So if you haven't checked that out, make sure you check that out as well. So we'd expect any given range, whether it be up or down, to play to the lower area where the investment was made and then to continue to the upside. Now, many people say, well, how do you know it's going to play from the lower area? We use fractal price action to identify the micro ranges at this level starting to break to the upside, for example, or starting to break to the downside. That is how we identify what the bigger time frame ranges are telling us. So liquidity in a range is always going to maintain if the structural points are going to hold. If the structural points don't hold and we see price coming below this, we'd look for what? A pullback to the investment that caused this new range to break down. In this case, an order block maybe halfway up to move itself. And then a continuation, right? That is the basics of what range liquidity is. So now that we've discussed the basics and you guys probably have a slightly better understanding, we're going to go down to the live price charts. Now, as you can all understand, the live price charts aren't going to be able to represent every single aspect of this for us perfectly. So what we're going to do is we're just going to wipe this off here. We don't need any of that stuff. And now we're going to talk about exactly how we can understand range liquidity and what we'd expect from it. So let's go on to a slightly bigger time frame here so we can start seeing what we got. So really simple stuff to look at. All we have to understand is every single range has an area that we'd want price to react at. Okay, now for this example, we're going to start off on the 15-minute time frame and we're going to be looking at this range. Now what makes this a range? For anyone that is unsure, it's exactly the same things that we covered in the diagram section above. We have a structural low right here. You can see the structural low. Price has then come below that structural low, meaning it's broken structure. Yeah. So when price breaks structure, it gives us a new range. We understand that this move started technically right at the top up here, but for now we're just going to talk about this top down to this bottom. Now you can see I didn't have to rewind price or anything like that to show you this. They are present everywhere and price is fractal, so you will see this on many time frames. And this is how you're going to be able to start introducing very nice trade ideas based off of basic range liquidity, understanding the way that it moves. So the first thing that we need to understand is every single time frame has range liquidity. And if you get caught on the wrong side of it, you will be liquidated like many other people. So always keep it in mind, the bigger range is going to dictate to us the overall price movement. Okay. Now, as you guys are probably very aware, the last upward shift before a down move will be represented as an order block on a bigger time frame. We're not going to go into that in this session, but again, we will be covering that in a different lesson. Now, if we have a range that goes from here down to here, what does that give us? It gives us a downwards move. understanding this is the high and this is the low. So what do we expect from any given range, whether it's upwards or downwards? We'd expect price to play back to the area that caused the breakdown. In this case, the break was here. The impulsive move came from this level and broke down. So we understand that the big guys are getting in at the top here. Now it's presented to us in the form of an upward shift before the downwards move. So that would be our ideal area to target. Now, we're going to work our way down this and we're going to talk about what the range liquidity areas are showing us and how price is reacting at each one. And you're going to start to see a pattern evolve in here. So we're going to just work our way down on the 15-minute chart and we're just going to simply mark the move itself and then we're going to mark the structure it broke. Okay, so this structure here is responsible for the break here. So it gives us a high and a low. So that gives us a downwards move. What would we expect from any downwards move that's given a range? A pullback to the area that caused the break. And then continue. When it continues, it presents to us a new range, right? It doesn't have to present to itself as one move. We expect this to pull back here because price is fractal. And we understand that by looking down at the smaller stuff here. You see how we were given a nice downwards push here. Price pulled back to the area. It gave another nice downwards push. Price pulled back to the area. So what are we seeing? The same thing that's occurring. Price is breaking down, pulling back. Breaking down, pulling back. Why? Because it's mitigating and reinvesting at the tops of the ranged liquidity areas. Now when we come down lower, we can start seeing the same thing occur. Now we're not going to worry about every single one because you guys are obviously going to see multiple different things happening here. But overall, having the understanding that not every range has to pull back because it's part of a bigger schematic is going to help you a lot to not get caught out by some of the bigger moves. Now here you can see that price wasn't that efficient at pulling back because it left a big gap. It did come back to the POI that caused the initial break of the smaller time frame lows over here. But it didn't come back to the top of the move to mitigate fully. So once it's hit that zone, so remember, the same thing occurs if we have a high, or in this case, a high and a low. It runs back, then liquidates the low, as we stated on the diagram section above. The same thing then occurs. What do we have? A breakdown, which broke structure, which I highlighted here. It comes back to the area that broke the structure, or the biggest investment point of a given move, to then continue and do what? Present us with a new range. The new range starting where the last investment finished and where the last move has stopped. Breaking structure, what do we expect it to do? Pull back to the area where the big guys invested and then continue to do what? Present us with new ranges, taking us lower. So how do we capitalize on these? We wait for price to run back to the zone that we have highlighted, whether it be a 1 minute, 15 minute, hour, whatever it may be. Always keeping your bigger time frame understanding at the forefront of your mind, because remember, the bigger time frames will lead you into the overall movement itself. So having this push down, waiting for it to pull back, and then waiting for a new range to present itself. So this would have broken smaller time frame structures in here. We then have what? A pullback to the area that price started moving down from. To then have what? The bottom of the range liquidated, a new high presented to us, a new low presented to us. In this case, it didn't actually clear the bigger low, but it presented a new low. And then where did price run back to? Back to the area that broke this low, which is this POI here, to then continue to make ranges again. A high, a low. How do we know that's the high and the low? Because it broke the structure. So what does price do? Runs back to the area that people invested at. The same thing occurs. We then have a new high, a new low. How do we know that's a range? Because it broke the structure. When does price run back to? The area that caused the break, or the area that the price was invested at. Notice how we have big ones, tiny ones, lots of different ranges, because they all give you directional help in the sense of where is price going. Now, one of the things you will notice is like here, where we have a high, then we have a low presented to us. What is going on here? What is this? It's imbalance inside of the market. Now, when we have imbalance inside of the market, it's completely fine, and you don't have to have every single balance leveled out inside the market in one go. Why? Because we know overall, when we're on a bigger time frame, we very well may have a move that comes all the way up like this, liquidating all of this area anyway. So the imbalance becomes irrelevant once this range is broken. So as you can see here, price came down again, doing the same thing over and over and over. It's on repeat. It will always do the same thing. Structural break, a high, a low, price pulls back. Again, structural break here, big structural break. Price runs back to the point of investment, continuing to break down. Runs back to the point of investment, continues to break down. Back to the point of investment, continues to break down. Also offering up smaller time frame ranges like so, doing the same thing. Continually repeating what it is doing. Now we're at the bottom of the move. So, for example, guys, we're going to use this as an example, as we're not going to go crazy into POIs and all this kind of stuff in this session because this is a range liquidity session. So we're going to use as an example, I don't know if there is, but we're going to say that there's a POI here. Yeah? We're going to say there's a POI here, just so we can show you this example. Now, this is how you would start to capitalize on a bigger time frame range move and catching it on a fractal basis on the minutes time frame. When the price comes into this area, what are we looking to do? Number one, we're looking at the range that took us into this area. So the high and the low. We then expect what? Price to run back. So in this case, we have a little push up before the push down. We expect it to tap into this and come lower, don't we? Remember, every single range has a protected high or a protected low, depending on what range you're in, and a liquidatable high or a liquidatable low. In a downwards range, the bottom is the liquidatable area and the top is the protected area, if the range is going to play the way we think it is. Now, when we come down into this area, look what occurs. We have the low, price taps into this area, not massively, but taps in nonetheless. So what would we expect after that tap in? We'd expect price to break this low. When it fails to break the low and you see price come higher, that is when we start getting our cues that price is now starting to create buy ranges rather than sell ranges. As soon as that level's broken at the top here, so right there you can see price comes above, taps above it. So what does that tell us? It tells us that the investment that was here has been liquidated. When that price has been liquidated, we can expect these upwards ranges that you see here. So break of structure, the low, the high, price pulls back to the area of investment. It breaks the bigger range that we're in. It then gives us a new high, a new low. What does price do? Runs back to the investment. Bear in mind, guys, at the same time, we're having fractal movements happening here. You know, happening inside of here, happening here, happening here. Fractal movements are happening everywhere. This is how we identify when our movements are changing inside of the market and how we would start to capitalize on the moves themselves. We're waiting for the investment to be contacted and the structure to be broken. Now, in this case, if we saw this high being taken out, we'd be looking for entries around this area, give or take. Now, when we zoom out to the bigger time frame, you can see if you'd have managed to catch this little range down here, you would have caught an absolute monster of a pump. Now, what happens once we break out of this area? Understanding that the shift in price here is caused by massive volumes, what do we expect when we break multiple structures from a low? We expect price to run back to the POI that caused the break. Now, you can see here where price has tapped into, which conveniently is home to a standalone order block, which is just below these highs. Very convenient, right? So price doesn't have to efficiently run all the way back to the main investment point and then go. It can just leave a gap because overall we are in a downwards trend anyway, so we'd expect price to come back to fulfill these gaps at some stage. So when we lead into a bigger area, you're always going to see price doing the same thing. It will always give you a range, pull back to the area of investment. If the low is not broken, expect it to be starting to move higher, giving you more upwards ranges, breaking structure, running back to, in this case, an imbalance, then presenting you with a new range, continuing to do the same thing. So this is how we use range liquidity inside of the market and how we start to identify what price may be doing. Now, I've shown you this on the price action over here. So take a look at this. Now, when I scroll slowly through this, look what you're going to be seeing. You're going to be seeing a very, very consistent thing happening. You're going to see lows broken, price run back to the POI, drop away. Lows broken, price run back to the area that caused the break. Again, presenting to us ranges pulling back, ranges pulling back, ranges pulling back, ranges pulling back, consistently moving down in this example. Okay, so looking at what you have, structural points always remain intact, breaking structures, pulling back to the investment point, and consistently moving over and over and over. So for anyone new to trading or anyone that is already a trader, this is exactly how we find our fractal entries, how we understand the whole market movement itself, and how we assess what markets are going to be doing next. So guys, for anyone watching this on record on YouTube, we are live in Discord. We are now going to give our students an opportunity to ask some questions. So guys, if you have any questions, please one at a time, try and keep it to the overall topic of the lesson. Let me know if you have any questions. I would love to hear your questions and answer them for you.
May I ask a question?
Yeah, sure.
It's my first time here. Pleasure to be here.
Great to have you.
My question is, how if I identify two blocks, for example, two order blocks, and they're like right above each other. Yep. There are 2 points of interest basically. Yep. How can I identify which is the correct block to place my entry upon it?
So
or is it at this moment?
The biggest thing that we need to really think about is where is the bigger move itself. Now, what time frame are you talking about overall?
Let's say I assess the chart from the 4 hour to 1 hour, and then I place my entry based on a 15 or 5 minutes, right?
Okay.
Is it the proper?
Yeah, so you can use whatever time frames you like. You know, it's completely up to you what time frames you use. So in this case, if we were looking for price to come back up, like I just stated here, so it's liquidated the low, it's now broken a structure. If we expect it to pull back to then continue to the upside, with that, what we'd like to see would be a reaction at this bigger area. And then where the reaction occurs, we can correlate with smaller POIs in here. Now, a lot of the time there will be imbalances, unmitigated areas, you know, POIs that stand out, you know, inefficiencies inside of the market, and that's where we'd be looking for. If you're unsure about order blocks and some of the fractal price action and stuff like that, check out the Telegram, and we do have some free lessons that we've already recorded in there, so obviously that can help you a little bit more, as well as the lessons in YouTube, which can help you with that a lot more. We will be hosting a lesson again on order blocks and POIs, so be sure to check that one out.
Appreciate it, bro. Thank you.
No problems at all. So we do have a question here in chat. So when it breaks the current high time frame range, do we then look for the high time frame range as a target? So when it breaks the current higher time frame range, so let's look at this right here. The current higher time frame range. So let's say, for example, it broke the down move. Yeah. Do we then look for a higher time frame range as a target? So if it broke this down move, so let's say it pushed down, we know it hasn't, it's right here, but let's say it broke this low. When it breaks this low, we'd be looking for it to pull back to the area that caused the break. Now, what you'd notice is it represents a range that's caused this break. The same thing occurs. We look for the area that caused the break, we look for price to run back, and then we look for smaller time frame ranges inside of here to break down to show us that that range is reacting in the way that we expected it to. So hopefully that's answered your question there, Miss Queen.
Yes, thank you.
Yeah, good. So because we don't really have any more questions, I'm going to wrap that up there. Feel free, guys, if you have any questions that pop into your mind after this session, drop me a DM. Also, be sure to check out the Telegram and check out the Discord if you're not part of the Discord. Obviously not for everyone that's watching this live. And if you do have any questions, please let me know. Also, we are taking suggestions for topics for lessons. We also offer one-to-one mentoring, and we do have a video course that is coming very soon. So guys, make sure you check that out, and make sure you hit that like button and subscribe button down below. But otherwise, I will catch you guys in the next one.